Well, students, finally in bonds, we will talk about term structure of interest rates. In the last video, we spoke about the price sensitivity, where we have plotted the price versus yield. So here we have to talk about the yield as a function of the maturity. Generally, what happens is as the maturity period increases, the yield increases. This is generally you will see in the bonds. This is quite natural to expect because if somebody wants to invest in a long-term bond, then one thing is they are taking very high risk, and second thing is they have to wait for a longer time to get their payment done. Therefore, they naturally expect more yield in such investments. That is why you will see that the bond issuers generally give higher yield for longer maturity. Although this is not always true, especially when the inflation is very high, at that time you will occasionally notice that the longer term bonds have lesser yield. This is because the investors doesn't want to invest in longer maturity bonds, anticipating that because the inflation is very high, the government will tend to increase the yield in the near future. Therefore, they don't want to go for a longer term bonds today when the inflation rate is very high. So in such occasions, you will see that the yield curve may go like this. Okay, but in any normal circumstances, you will always see that yield goes up as maturity period is large. The data plotted here is not a real-time data. I have just given a rough idea here. The annualized normal interest rate, which is precisely the yield of a zero coupon bond, okay, with maturity time T, is called a spot rate and is generally denoted by ST. And the collection of spot rates of all maturities is denoted by this ST, where T belongs to this. Say, for instance, the 5-year, assume that this is a zero coupon bond. Okay, that is, I've plotted the maturity versus yield of a zero coupon bond. Just assume that. Then at T equal to 5, ST is around, say, S5, because for a given T, we denote the corresponding spot interest rate by ST. Therefore, S5 is around 5.7. And similarly, say 10, S10 is around 6.45 and so on. So these are the, I'm just roughly drawing. So this is S15 is 6.8 and so on. Okay. So these are called the spot rates, and the collection of spot rates of all maturity, that is, if you just take this denoted by this, is called the term structure of the interest rate. Okay, so we are in this section interested in trying to understand the term structure of interest rate of a bond. So let me just give a very simple example. Suppose a zero coupon bond. Remember, the spot rate is only defined for zero coupon bond. Has S1, that is 1 year spot rate, is say 5%, and 5-year spot rate, that is you have a zero coupon bond. So if you go for 1 year investment in that bond, then you have 5% interest rate. Okay. In the same bond, if you choose for 5-year investment, then the issuer gives you 7%. Okay, so like this only it happens. The issuer is same, the bond is same, but your yield, that is the interest rate of the bond, depends on your maturity period. Whichever maturity period you choose, accordingly your yield will be applied. Generally, if you choose a longer period of maturity, then you tend to get a higher yield. Okay, so that is the idea of the term structure. Issuer generally gives you the yield for different maturity period. If a bond is giving 5% for 1 year spot rate and 7% for 5 year, if the face value was taken like this, it means if you opt for 1 year maturity, then you will get 105 rupees because it is 5% yield. In the same bond, if you opt for 5 years maturity, then you will get 7%. Annually compounding, therefore, the first year it will get 7%, and then it's a zero coupon bond, so they don't pay you the coupon, but they accumulate it in the principal and calculate the 7% for 107 rupees for the second year, and so on. So in that way, if you compound annually, after 5 years, your bond will return you. So therefore, that is the idea of spot rate. Please note that this kind of behavior, that is a longer maturity, has a higher yield, that is this kind of thing, is not only for zero coupon bonds, there for coupon bonds also. Okay, there is nothing really specific for zero coupon bonds. Here, theoretical reasons, we assume that the concept of spot rate is applied only to zero coupon bonds because theoretically it's more comfortable to calculate these spot rates, but in reality they are applicable to coupon bonds also. That is this idea. Term structure idea is applicable to coupon bonds also. When I say that I'm going to define this spot rate idea and study this term structure only for zero coupon rate, when I say that, it looks a bit artificial. Well, we are doing it for theoretical simplification, but in practice, it looks a bit odd because in market, most of the bonds are coupon bonds. There's hardly any zero coupon bonds. Therefore, such an important concept of understanding yield versus maturity is studied only for zero coupon bonds, which is very rare in the market. So why such a thing is happening? Because, well, it is for theoretical simplification, but one can, without loss of generality, assume that a bond is zero coupon, because once you develop the concept of spot rate and term structure for zero coupon bonds, it can be easily adopted to coupon bonds. How? Let me illustrate this through an example. See, suppose you have two bonds. They are coupon bonds. Well, as per our definition, we have to apply the spot rate idea only to zero coupon bond. But what I'm going to do is, I have, suppose, two bonds, okay, trading in my market. With the help of these two bonds, I can make a portfolio which is equivalent to the zero coupon. How can I do that? Let us try to understand. Remember, portfolio means a collection of assets. If you say bond portfolio, it means a collection of one or more bonds together is called a bond portfolio. Similarly, you have equity portfolio or a general portfolio where you have assets mixed together, collected together. Some are bonds, some are equity, and so on. So we will try to construct a portfolio out of the coupon bonds, which finally is equivalent to a zero coupon. Okay, why I'm giving this example? To show that even when you are dealing with coupon bonds, by combining them properly, you can convert them to zero coupon bonds and hence go to study the spot rate for your portfolio. Okay, so that for that reason, I'm just giving this example. Let us see, you have two bonds. One is a coupon bond with duration 10 and the coupon payment is 10%. So both bonds are 10 years and both has face value 100. Now let us see how to construct the portfolio in such a way that it is equivalent to a zero coupon bond. Remember, the idea is that both the bonds are giving coupons. Somehow you have to cancel them in order to get a zero coupon at the portfolio level. Okay, so how are we going to do? Look at this. This has 8% coupon and bond A has 10% coupon. Okay. So suppose I buy 5 bonds of bond B. It means I pay 85.89 into 5 and get 5 bonds. Okay. Whose face value combined together is 500 rupees. And how much coupon I will be getting every year? I will be getting 5 into 8, that is 40 rupees. Okay. If I have to cancel that 40 rupees, what I should do is somehow I have to give up that 40 rupees. That is how I will get a 0 coupon, right? So how will I give up that 40 rupees? You go to sell the bond A. How much? I need 40 rupees. So it is 4 bonds I will sell in bond A. This is one way of cancelling the coupons, right? You can also do it in many other ways. So this is just one way of doing. So I will buy 5 and sell 4. Okay. So here this looks a bit odd. What is meant by selling? What if I don't have bond A? That is, I have never purchased bond A in past. How can I go to sell it? It is possible. It is called shorting. Okay. So you are taking a short position in bond A, quantity is 4, and taking, this is called a long position. So these are technical words people use. Long position. You are taking long position, quantity is 5. Okay. So such things are allowed in stock market, that you can sell some asset without even owning it. So in the case of bonds, shorting a bond is equivalent to borrowing, you see. And similarly, going long, that is buying bond, is equivalent to lending, right? Such things are possible. So when you go to short a bond, it means at the coupon time, you have to pay the coupon rate to the person who bought it from you. Okay. So it is just a virtual, there is no bond that exists in your hand, but you went to sell it. Okay. And somebody, some person in this world, which you don't know, has bought from you. Okay. Just empty hand. You are selling from empty hand and he is buying, paying money to you and buying it. Okay. So such things are possible in stock markets. It's little bit uneasy to believe such things, but these are possible. Now, since you have shorted this bond A, it means it's equivalent to borrowing. At every coupon period, you will be paying 10% to the person who bought these bonds from you. Okay. Therefore, you will be giving minus 40 to somebody through bond A, at the coupon period, and through bond B, you will be getting same 40 rupees, right? Because 5 and bond B is 8%. So totally at every coupon time, your total coupon payment is 0. So our portfolio, therefore, is 4 bonds in A category you shorted and 5 bonds in bond B you bought. Okay. So this together is now combined as one bond portfolio. Let us just imagine that these two combined is a bond. Just imagine that. Then what is the cash flow? Initially you paid, so some price you paid, okay, and every coupon time you have 0, 0, 0 and so on, and finally something comes, right? PN. Okay. How much will come? 400 will go from you at the end of the maturity and 500 will come back. Okay. Therefore, what is the face value of your portfolio? The face value of portfolio is 100 rupees. Okay. Because 400 will go from you because you initially sold it. Therefore, at the time you have to buy. So you will pay 400 and buy back what you sold at the maturity, or any time that you want to close this position, you have to buy it back. And whenever you want to close the position in bond B, you have to sell it. Thereby you will get 500 rupees from bond B and 400 rupees will go from you from bond A. Therefore, your face value of your portfolio is 100 rupees. Okay. So this kind of strategies we will be using it from now onwards. That's why I'm giving little time and explaining you. What is the price that you paid? Well, while buying bond B, you bought 5 volume, therefore 5 into PB, sold bond A, thereby that money came to you. Just it's a kind of opposite. Okay. You paid 5 times PB and you got 4 times PA. Okay. Therefore, the price that you paid is the difference between these two, that is 34 rupees 57 pice. Okay. If you write a cash flow from your point of view, this will come as minus 34.57 because this money went from your hand. So therefore, cash flow of the portfolio is minus 34.57. That is, you spent this much money to take a position in this portfolio, and then every coupon period, you don't have any coupon because they get mutually cancelled with each other. And finally, what comes to you? 100 rupees. So this is a cash flow of a zero coupon bond. You put some money and finally you get a bigger money in your hand, which is coming because of the accumulation of the interest, right? Now, what is the interest that you got? The interest that you got is the spot rate. Why we call it spot rate? Because we have constructed our portfolio as a zero coupon portfolio. Therefore, by definition, the yield I will call as spot rate. Okay. How the spot rate is given? Remember, the price of the bond, okay, is equal to the face value divided by the discount factor. What is the discount factor here? Say the spot rate is S10 because it's a 10-year bond, right? So spot rate is called S10. This is a notation. Therefore, it is 1 plus S10, that is per annum, to the power of 10. This is the present value formula, if you recall, for the zero coupon bond. Okay. In this, we know this, we don't know this. Okay. Therefore, you can find this using this equation. How will you find? S10 is nothing but P10 divided by P0 to the power of 1 by 10 minus 1, right? So that is the formula for the spot rate of your portfolio. So you just plug in all these numbers, you will get the spot rate as 0.11. That means 11.2%. Okay, so that's the spot rate. So if I give you 2 bonds, okay, and ask you to construct a suitable portfolio and find the spot rate, it means what? You have to construct a zero coupon portfolio out of the given bonds. So I will give you some amount of bonds. I will ask you to construct a suitable portfolio for which you can find the spot rate and find the spot rate of it. So if I coin a question like that, then you have to carefully write a portfolio which is equivalent to a zero coupon put. Once you have this, then you have to find what is the face value, what is the purchase value. Then you have what is the year, then that year n is equal to face value divided by purchase value to the power of 1 by n minus 1, right? So that's the formula. The next topic is forward rate. So let us recall, we had an example where we have a bond with 1 year spot rate being 5% and 5 year spot rate being 7%. So if you ask question whether we prefer the 1 year maturity bond or 5 year maturity bond, well, in terms of the maturity amount, obviously one look for 5-year maturity. But just assume that the person who is interested in this 5-year maturity doesn't have money at this point, but he might get money somewhere here. Okay. So, but he may be worrying that in 1 year, the 7% may come down to say 6% or something like that. Then in order to retain this 7% or something near to 7%, the person can go for what is called as the forward rate. Let us see precisely what is meant by forward rate. A forward rate for some period T1 to T2, that is, so we are at T equal to 0, that is the present time. And then you have 1 year, 2 year, and so on. And then you have T1, T2. T1 to T2 can be any number. It can be 1 or 2 or any number. Okay. Now we are here and we know that we want to invest our money during this period. Okay. But at that time, we may be having a different spot rate, that is in particular yield. Remember, spot rate can be any interest rate, in particular yield, as far as you have one-time payment, right? So you have initial payment P0 and then you have PN, no in-between payment. Any such cash flow, you can talk about the spot rate. Okay. So if I want to somehow make my interest fixed today, what you can do is you can go for a contract with somebody saying that, well, from T1 to T2, you can lend money for certain percentage. Okay. So the forward rate for any period T1 to T2, which generally we denote by this, is an annual interest rate. So sitting here, you are deciding what interest you want to get at the future period. Okay, that's an annual interest rate for money. Either you may be investing for that or you would like to borrow money for that period at time T1 in future till the maturity time T2. But under terms agreed upon the present time. So you will sit here and agree with somebody else about whether investing, that is lending or borrowing money at some future time for a fixed percentage, that is denoted by FT1 to T2. Okay. So this much percentage I will either borrow from you or I will lend to you at time T1, which is the future time, till the maturity T2, which is obviously the future time. So that concept is called the future rate. What is the formula for future rate? So there is a way to derive the formula for future rate is using comparative principle. What is that? We will try to compare two spot rates of different periods. Okay, it can be a spot rate at T1 and spot rate at T2. Just to simplify our concept, let us try to understand it for 1 and 2, then it's just a straightforward generalization to any future time. Okay, you have spot rates. Okay, so you don't need to understand all these concepts from a bond point of view. You can understand it from any interest rate point of view. In particular, they will apply to yields of a zero coupon bond. Suppose you have two different spot rates, that is from the zero coupon bond point of view, you have a zero coupon bond for which the spot rate for 1 year period is given and the spot rate for 2 year period is given, that is yield for 1 year is given and yield for 2 years is given. Now the comparative principle says that using this information, you can obtain a forward rate using this equation. What is this equation? Let us try to understand. What is the right hand side? Right hand side is nothing but the future value of the 2-year bond. Okay, future value is the initial price that you paid 1 plus S2. Remember, we are assuming the compound interest compounded annually. So with that, this is the future value, right? And similarly, suppose what you did is you went for 1 year, okay? Therefore, the future value of this is P naught into 1 plus spot rate of 1 year bond. That is, the future value is this. And now from here to here, instead of going for S2, you went for fixing a forward rate, okay? Thereby you have, so this is precisely the future value of this scheme. That is, first year you will go with this bond, and then the second year you will exit this bond and get into your forward agreement for the rest of the 1 year, okay? So you equate these two. That is the main principle of comparative idea. Okay. So they both should be equal. That is your principle. So once you do this, you know this, therefore you can obtain this easily, and it is given by so. So according to this comparative principle, your formula for forward rate, if you go for the contract from your next year to this, okay, how you will decide this forward rate is by, in the market this rate will be available, in the market this rate will also be available. S2 is for the whole period, okay, S1 is for only one period, and this is F1 2, okay, is only for this period. Instead of going for the entire 2 years, if I go for only this through a forward contract, what is the rate that I can look for to get a contract with somebody is given by this formula. So once you get this idea clear, you can generalize it to any I and j instead of 1 and 2. And this is also called implied forward rate. Okay, so this is implied forward rate because you see, this is a theoretical prediction, or theoretically you are just trying to judge what could be a nice value for your forward rate. But in market, the traders, they decide in their own way. By trading, they decide it in their own way. Therefore, that is called the market forward rate. Okay, what market decides is called market forward rate, and what is this formula gives is called implicit forward rate. So once you understood this concept, the generalizing it to any interval of future time I to j can be done very easily. You take any time, the comparative principle, you take any I, okay. So present, you are sitting in the present time, you are trying to fix a interest rate with somebody, the jth year to kth year, okay. If you want to do again the same idea of comparative principle, and from here you can just find fj comma k as this, okay. So this is the implicit forward rate. We have used the comparative principle to derive the forward rate. Often the market forward rate deviates from the forward rate that we calculate using the comparative principle formula, that is implied forward rate. However, whenever the market forward rate deviates from the implied forward rate, it tries to stabilize with that. So that is the power of comparative principle. Let us see this through an interesting example, which also introduces us to a very important concept called arbitrage. Suppose at some time t, the spot market, it means the secondary market, offers 5 and 6% spot rate for 1 year and 2 year zero bonds, zero coupon bonds respectively. That is, S1 is 0.05, that is 5%, and S2 spot rate for the 2-year bond is 0.06. Now assume that the market offers the forward rate as this. Okay, so this is not computed from the implied forward rate as per the formula derived above, but this is just coming from the market say. Recall, comparative principle states this equation. Now, you put S2 is equal to 0.06 here, you will get 1.1236. On the other hand, you come to the left hand side, S1 you put here and F12 you put here, you will get 1.1287. Thereby, you can see that the left hand side is greater than right hand side, right? It means the market forward rate deviated from the comparative principle. Let us see what happens if the market forward rate deviates from the implied forward rate. Our friend, say, let us call him as Meg, noticed this mismatch. And what he did is he immediately planned a clever strategy. What is that? Let us see. He sold the 2-year bond in the spot market. That is this scheme. Let us call this as RHS scheme. That is buying the bond for 2-year maturity. And let us call this scheme as LHS scheme. It means you first buy the 1-year maturity bond, and at the same time you also go for a forward contract which is offering you 7.5% from the first year to second year from today. That is the LHS scheme. What our friend Meg did is that he sold the RHS scheme. Remember, you can short in the market. It means equivalent to borrowing money from the RHS scheme. In other words, he short the bond in RHS scheme. In other words, he sold the RHS bond, that is 2-year bond, without having it in hand. And then what he did is went for the LHS scheme. That is, he took money borrowed. That is, from here he will get money because he sold it. So he got money and invested it into LHS scheme. It means what he did, he first bought the 1-year bond in the spot market, which is he is getting it for 5%, and simultaneously he went for the forward rate from 1 to 2 year, that is F12, applied F12, which is 7.5%. So this is the complete strategy that Mr. Meg has adopted. Now let us see what he is gaining through this strategy. First and foremost, observe that he did not spend any money from his pocket because he borrowed from RHS scheme and put into LHS scheme. That is the plain strategy that we can take off. Therefore, he has not spent any money from his pocket. For simplicity, let us assume that Meg traded 1 unit in this bond. Okay, that is, he sold 1 unit and bought 1 unit. And also for the calculation purpose, let us assume that he bought and sold both for 100 rupees. In reality, it may not happen like that, but for our calculation purpose, let us assume this. Also, we will assume that these trades, all these trades are frictionless. What it means, generally, when you trade in markets, you have to pay other charges like brokerage, tax, and so on. Let us neglect all these other charges. That is what people call as frictionless trading. So this means borrowed an amount of 100 rupees and the right hand side scheme was coming with 6% interest 2 years, right? So therefore, he has to pay it back. After 2 years, he has to pay it back an amount of 112 rupees 36 paise. Remember this, he has to pay after 2 years 112 rupees 36 paise. That is the liability he has for the right hand side scheme because he short it. Now he took that money 100. Today he got 100, but after 2 years he has to pay 100 plus this interest. Okay. Now whatever he got today 100 rupees, he invested into the LHS scheme. Okay, that 100. So he has not spent any money from his pocket. What is the LHS scheme? It is 1-year bond with S1, that is 5% spot rate. And then at the end of the year, he will get 105 rupees, right? Because 5% interest rate he is investing, therefore he will get 105 rupees from the 1-year bond, and then he already got the forward contract. Therefore, after the end of 1 year, he will put this 105 rupees into the bond with the rate 7.5. That is what the forward market offered him. So totally what he will be getting after 2 years from these two combined together, that is, first he put 100 rupees. After 1 year, he got 105 rupees that he put into the forward rate, and finally he will get this money. So at the end of 2 years, to the RHS, he has to pay 112 rupees 36 pice, but LHS scheme, he got 112 rupees 87 pice. What is the difference? The difference is 51 pice. So in this strategy, you can see that in 2 years, he did not spend any money from his pocket. And suppose this bond is a government bond, he has no risk at all. And in 2 years, he got 51 pice in this deal. Okay, it may sound very little. Oh, in 2 years, he is getting only 51 pice. Don't think like that, because we have calculated this for 1 unit. Okay, since he is not putting any money from his pocket, he can literally increase this unit to any amount. Say 1 lakh unit he can trade in this strategy, right? Or even more, because anyway he is not going to put any money. Whatever he borrows, he will put it into the right hand scheme. Therefore, any amount of unit he can buy. Okay, let us say he bought 1 lakh unit. So it means 1 crore rupees he got from the left hand side scheme, and he just invested into right hand side scheme, and just he did his own job. He did not care about it. No, there is no risk at all. So if he does that, at the end of 2 years, he got 51,000 rupees without putting any effort. The market has given him riskless and principal-less profit of 51,000 rupees in. Okay, such an opportunity is called the arbitrage opportunity. Sometimes market do give such opportunities, and there are people who will sit and look for such opportunities. They are called arbitrages. See, in the above example, we have seen that the way we have taken the parameters gave us this inequality. We can also choose the parameters such that the inequality goes like this, in which case can accordingly alter his strategy and still make a arbitrage out of that mismatch in the market forward rate and the implied forward rate. Whenever there is a mismatch in the forward rate from implied and market, immediately arbitrages will enter into the trades, and then that gap will automatically get corrected. Okay, so often in market, arbitrage comes and immediately it goes in very less time, even in seconds. Okay, that is why generally in our theory, in the later part, we will always assume the market is arbitrage free.